Hey there, money-hungry viewers. Welcome back to Mad Money. It's a wild world out there in the market right now. We've got trade wars brewing, economic data rolling in, and investors trying to make sense of it all. Today we're breaking down the latest market moves and what they mean for your money. So, buckle up, because things are about to get interesting. We'll be diving deep into President Trump's new tariffs and their potential impact on the economy. Plus, we'll look at the upcoming economic data that could make or break the market's momentum. And of course, I'll be sharing my thoughts on where I think this market is headed. Let's kick things off with a look at the stock market. Today has been an interesting day for investors and traders alike. Despite all the trade war drama, stocks managed to climb higher today. This upward movement has surprised many, given the ongoing tensions between major economies. Futures pointed to a positive open, and the major indices followed suit. Investors seemed optimistic right from the start, setting the tone for the day. The Dow Jones Industrial Average Futures rose 0.2%. This modest gain reflects a cautious optimism among investors. The S&P 500 futures added 0.3%. This index, which represents a broad swath of the market, showed resilience in the face of uncertainty. And the tech-heavy Nasdaq Composite futures gained 0.4%. Technology stocks, often seen as growth drivers, led the charge today. This comes after a rough week for the market, with all three major indices closing lower. The recent declines had many worried about a potential downturn. Now, you might be wondering why stocks are rallying when there's so much uncertainty surrounding trade. It's a valid question given the headlines we've been seeing. Well, some analysts believe that the market may have already priced in the potential negative impact of tariffs. This means that investors might be less reactive to new developments. Others suggest that investors are simply looking past the trade war noise and focusing on the strong underlying economy. They argue that solid economic fundamentals can support continued growth. Additionally, some market participants are betting on potential resolutions to the trade disputes. They believe that negotiations could lead to favorable outcomes. It's also worth noting that corporate earnings have been strong, providing a boost to investor confidence. Many companies have reported better than expected results. These earnings reports have helped to offset some of the negative sentiment caused by trade tensions. Investors are finding reasons to stay optimistic. Of course, the market remains volatile and things can change quickly. But for now, it seems that the bulls are in control. As always, it's important for investors to stay informed and be prepared for any eventualities. The market can be unpredictable, but staying informed can help navigate the ups and downs. We'll continue to monitor the situation and bring you the latest updates. Stay tuned for more insights and analysis on the ever-changing world of finance. Thanks for watching, and we'll see you next time. Speaking of trade wars, let's talk about President Trump's latest move. The president announced new tariffs on steel and aluminum imports from Canada, Mexico, and the European Union. He also slapped tariffs on billions of dollars worth of Chinese goods. These tariffs are designed to protect American jobs and industries, but they've also sparked fears of a global trade war. Other countries have already retaliated with tariffs of their own, and this tit-for-tat could escalate further, hurting global economic growth. The tariffs are already having an impact on some businesses. Companies that rely on imported steel and aluminum are facing higher costs, and these costs are being passed on to consumers in the form of higher prices. Now, let's talk about the potential economic implications of these tariffs. The biggest concern is inflation. When tariffs are imposed, the prices of imported goods go up, and this can lead to a broader increase in prices across the economy. Another concern is that tariffs could hurt international trade. When countries impose tariffs on each other's goods, it becomes more expensive to trade. And this can lead to a decrease in global trade, which would be bad news for economic growth. Russell Investments, a global investment firm, warns that the tariffs could have a significant impact on the global economy. They argue that the tariffs could lead to slower economic growth, higher inflation, and increased market volatility. So, with all this trade war uncertainty, investors are looking for any clues about the health of the economy. And that's why we're keeping a close eye on the upcoming economic data. This week we'll be getting the ADP Private Sector Employment Report, which will give us an early look at the job market. We'll also be getting the Federal Reserve's Beige Book, which provides an anecdotal overview of economic conditions across the country. And next week, we'll be getting the big one: the Bureau of Labor Statistics Jobs Report. This report will tell us how many jobs were created in May and what the unemployment rate is. Section 6. Jobs, jobs, jobs. The job market is a critical indicator of economic health, and it's something that everyone from Wall Street to Main Street keeps a close eye on. The jobs report is always a big deal for the market. It provides a snapshot of how many jobs were added or lost, the unemployment rate, and wage growth. These numbers can move markets and influence economic policy, but it's especially important right now because the Federal Reserve is watching the job market very closely as it decides whether or not to raise interest rates. The Fed uses this data to gauge the health of the economy and to make decisions that can affect everything from mortgage rates to the cost of borrowing for businesses. If the jobs report is strong, it could give the Fed more ammunition to raise rates. A strong report indicates that the economy is robust, with businesses hiring more workers and potentially increasing wages. This can lead to higher consumer spending, which is good for economic growth. But if the report is weak, it could cause the Fed to hold off on raising rates. A weak jobs report might signal that the economy is slowing down, with fewer jobs being created and possibly even layoffs. This could lead to lower consumer spending and a slowdown in economic growth. The Fed has already raised rates twice this year. These rate hikes are part of its strategy to keep inflation in check while trying to sustain economic growth. And it's expected to raise rates at least 2 more times before the end of the year. Analysts and economists are closely watching the Fed's moves, as these decisions can have wide-ranging impacts on the economy. Higher interest rates can be a drag on economic growth. They make borrowing more expensive for consumers and businesses, which can lead to reduced spending and investment. This can slow down the economy and potentially lead to higher unemployment. So the Fed is trying to strike a delicate balance between keeping the economy growing and keeping inflation in check. It's a challenging task, as raising rates too quickly can stifle growth, while not raising them enough can let inflation get out of control. The job market data is a crucial piece of this puzzle, helping the Fed to navigate these complex economic waters. Section 7. What's next for the Fed? The Fed's next policy meeting is scheduled for June 12th and 13th, and investors will be listening very carefully to what the Fed has to say about the economy, inflation, and the path of interest rates. If the Fed signals that it's still on track to raise rates 2 more times this year, it could boost the dollar and put pressure on stocks. But if the Fed sounds more dovish, suggesting that it may raise rates only once more this year, it could weaken the dollar and give stocks a lift. The Fed is walking a tightrope right now. It needs to raise rates to keep inflation in check, but it also doesn't want to raise rates too quickly and risk choking off economic growth. Section 8. Investor sentiment, a mixed bag. So, what does all this mean for investor sentiment? It's a question that has many layers and no simple answers. Well, it's a bit of a mixed bag right now. Investor sentiment is a complex and ever-changing landscape, influenced by a myriad of factors. On the one hand, investors are encouraged by the strong economy and corporate earnings. The robust performance of many companies has given them a reason to be optimistic. But on the other hand, they're worried about trade wars, rising interest rates, and the potential for a market correction. These concerns are not unfounded, as geopolitical tensions and economic policies can have significant impacts on the market. Some investors are starting to get nervous. The volatility in the market has made them cautious, and they're closely monitoring every piece of news that could affect their investments. They see the market as overvalued and due for a pullback. The high valuations of stocks have led some to believe that a correction is imminent. Others, however, are more optimistic. They believe that the bull market still has room to run. These investors are focusing on the positive economic indicators and believe that the market will continue to grow. The truth is, no one knows for sure what's going to happen in the market. Predictions can be made, but the market is inherently unpredictable. The market could go up, down, or sideways in the short term. This uncertainty is part of what makes investing both exciting and challenging. But over the long term, the market tends to go up. Historical data shows that despite short-term fluctuations, the market has a tendency to grow over the long haul. So, if you're investing for the long haul, don't let the short-term noise distract you from your goals. It's important to stay focused on your long-term strategy and not get swayed by the daily ups and downs of the market. Diversification is key. By spreading your investments across different asset classes, you can mitigate some of the risks associated with market volatility. Seek advice from financial experts. They can provide valuable insights and help you navigate through uncertain times. Remember, investing is a journey, not a sprint. Stay informed, stay patient, and stay committed to your financial goals. Section 9, Kramer's closing bell. All right, folks, that's all the time we have for today. Here's the bottom line. The market is facing some headwinds right now in the form of trade wars and rising interest rates, but the economy is still strong and corporate earnings are solid. So what should you do? Don't panic. Stay the course and keep your eyes on the long term. And remember, there's always money to be made in the market, even in times of uncertainty. That's it for me. I'll see you tomorrow for another exciting episode of Mad Money.